we have seen enormous flows in ETFs. I've watched the SPY, the largest ETF. We've seen essentially 4 times normal volume in the last month or so. I was particularly interested in watching the corporate bond ETF, the LQD. Last week, we saw a 25% increase in the shares outstanding. I think the prices were up 20%. And essentially, it seemed like investors were trying to front run the Federal Reserve, who announced that they were going to be buying corporate bonds and corporate bond ETFs. I wonder if you could comment on what you saw there. There was a lot of criticism that in the LQD closed their prices with different from the net asset value by about 5% at a discount. And I guess the question is, who was wrong here? Was the ETF model wrong, or was it the bond pricing model that was wrong here?
Well, first, thanks, Bob, for having me on. One, I'd like to just first point out, ETFs were born out of the 87 crash when the stock market went down 22% to actually help exhaust the risk transfer and make it orderly and efficient. I think ETFs have performed terrific during this time period. If you look at LQD and SPY, 2 of the biggest ETFs have essentially become the risk transfer vehicle of choice, given that other markets were in disarray from a liquidity and risk transfer perspective. So look at the investment grade ETF LQD. You know, on the high point, it traded $6 billion worth, $5 billion worth. And you look at the discount, it's just reflective of where the bonds were trading. And so there is a lot of discussion that the ETFs were trading at below fair value or at its posted NAV. I'd say that the way that the NAVs are constructed, the bond market is slow to catch up where the market is pricing real time where LQD was trading. So where you can freely buy and sell, the markets are fair. And I think that from the perspective of market structure, you know, it's probably some refinements are needed in order to bring more transparency in the online marketplace where bonds are trading real time.
Yeah, but I mean, you gave the answer there. I mean, the ETF haters want to say, oh, see, you know, this is the problem here. But it's not the ETF structure that's wrong. It's the way you price bonds. After this is over, Reg, are we going to have to rethink the way bonds work in the modern market structure? Is there a better way to do this? More electronic trading in bonds, for example. What's the solution to keeping that gap between pricing for the ETFs and the net asset value as small as possible?
Well, look, first of all, the bond market is $10 trillion. And if you look at the structure of the bond market, nearly, 4 or 5 trillion of that is triple Bs. And so there's downgrades, you know, there'll be some repricing in that marketplace. I think what's needed most is some refinement, but more transparency where the bonds are being priced. And in my opinion, I've been talking about this for a week or so, that I think you need more transparency where bonds are trading in real time, aggregate where the prices are at, and find a best bid, best offer. So there's a lot of increased confidence where bonds are trading, just like you have in equities.
Right.
And so
how do you get more transparency?
Well,
how do you get that? Is it electronic trading? What provides the transparency?
No, I think what you need, just like in equity markets, although bonds are different and the marketplace is larger, I think you need to aggregate under a SRO to basically create a security information processor and transmit where bonds are pricing in real time. Listen, at the height of the repricing in the marketplace, a lot of the electronic algos didn't understand or didn't know where to price the bonds, and is only looking for customers to indicate where they're willing to buy. And so we have that scenario, like it occurred earlier this month. You need to have a lot of transparency to bring everyone in the marketplace and bring enough capital into the marketplace real time. So if you have a better structure around corporate bond trading, by bringing the best bid, best offer, transparency, and transmitting that, I think more people have confidence where the underlying market is really trading, right, and not just rely on ETFs.
What you're saying implies that the current structure isn't working. I guess, do we need a new way of trading bonds at a new exchange or something like that? I'm trying to get into the weeds a little bit about this, but
I think we'll sit back and ask our questions. What went well? What didn't go so well? What did we learn? And look at the empirical data. And so if you look at the open-ended 40 Act mutual funds, first of all, only 20% of the entire bond landscape trades per day. So that means that 80% of the marketplace does not trade or change hands. You don't have a real-time pricing agent. And so you have in the ecosystem a real-time, in the ecosystem you have a fair value agent that's picking a price where they think the bond should be priced. And unless you have a real-time mark, you just don't know. So I think refinement of the entire corporate bond marketplace is in order. I know that there's a couple committees at the commission looking at this, and I think that there's a lot of evidence that we can point to say what well, we did not. And what didn't go so well, in my opinion, is transparency of where the underlying corporate bonds are trading with respect to where ETFs are pricing in real time.
Yeah.
If market makers like myself,
let's
like
hope.
GTS, go ahead.
Yeah. Let's hope that would be one great thing to come out of this. Better, more transparency. The ETF structure is accurately guessing where these prices are supposed to be, just like they did with the China market. When China was closed for several weeks, the ETFs, the China ETFs that traded here, very accurately reflected where they would reopen. So it's obvious that it's the structure of the bond trading that's the problem, not the structure of ETFs.